Hello and welcome back to the Trinity Student Managed Fund podcast with me, Emanuele Roncalli di Montorio-Veronese, where I speak with leaders in the world of business, finance and technology to give our students a better insight into the careers we may wish to pursue. Today I sit down with the legendary Howard Marks, co-founder of Oaktree Capital Management and one of the most influential investors of our time. In this conversation, we discuss how he built Oaktree into the powerhouse it is today and the culture that drives it. We also dive into his highly successful investing career and unpack the philosophy that's shaped his distinctive approach to markets. This episode is full of timeless insights and hard-earned wisdom. I hope you enjoy this conversation with Mr. Howard Marks. Well, Mr. Howard Marks, 5 years later, it's a real privilege and honor to have you back, so thank you. And I suppose to dive right in, I think a great place to start is if we rewind the tape back to 1995 when you were building Oaktree. I read that the kind of unspoken question was, how would you get back to the 7 billion at TCW? And you started, please correct me if I'm wrong, but you started Oaktree in 1995, had 5 billion under management by the end of the year. By 97, 10 billion. I'd love to know, what was it like raising the first fund so successfully? And building Oaktree, the early days with Bruce and your other partners from TCW.
Well, Emanuele, it's a pleasure to be back with you. As you say, that question was unasked. We managed 7 billion at TCW. I don't think we took a view on whether we would get back to 7 billion. Seemed like a lot of money. I think that we just thought that if we thought we had done a good job for the clients, and if we continued to do a good job for the clients, we'd have a successful business. However that was defined. We didn't have any projections. We didn't have a profit plan. I always say that in Silicon Valley, they start companies on the back of a napkin. We didn't have a napkin. But we had worked together for 9 years with success. And we wanted to keep working together in a firm that ran our way, which means adhering to our investment philosophy and business principles. And so obviously we quit on March the 10th of 95. We opened the doors at Oaktree April the 10th, the five of us. We were joined on the first day by, I think, 27 other people from Oaktree, from our group there, which means we started with 95% of our group intact, and we just had to move forward and do the same things equally well. Obviously, we spent that whole year talking to the TCW clients about coming over, and as you say, by the end of the year, 5 of the 7 billion of former TCW clients had come over. We probably get another billion the next year. So maybe, let's say, 6 of the 7. And we were very fortunate. We got good coverage. I think our reputation helped us. Had a lot of goodwill from the clients, and most of them took the view. One of them said it in print in a Wall Street Journal article that was extremely helpful, that everybody has to reach their own conclusion, whether they went to TCW or went there because of us. And he said, we did it because of the group, and we're going to follow them to Oaktree. And that kind of thing was very influential, but I think a lot of people reached the same conclusion, fortunately.
I think one of the things Oaktree is most well known for, and I was just speaking to a colleague there about it, is the culture. So I'd love to know, how did you build the culture? And I read that you have a no jerk policy. Maybe you could elaborate on this and how you define it.
Well, we had this great advantage that when we started, we didn't have to sit down and say, okay, what are we going to do? How are we going to run money? What's our approach? What kind of environment do we want? We had worked together. We knew these things. We just had to write them down. We were of one mind on these subjects. So, and as you know, I love to write, and my normal recourse is to write, because I think it makes you, it forces you to solidify your thinking. And so we wrote down an investment philosophy with 6 tenets. Never have changed a word of that. And 30 years later, I think it's still 100% applicable, and that was the easiest part. Risk control, number one. Consistency, number two. Only active in less efficient markets. High degree of specialization, not relying on macro forecast, not reliant on market timing. Period. And we wanted a firm where every strategy ran according to the same approach. I think that, I don't know exactly, but I would imagine that a good number of investment management startups enunciate their business, their investment philosophy. But we also wanted to make clear our business principles, which are non-investment, the kind of organization we wanted to be. And so we wrote something called Business Principles. They're both available on the website. Most people don't read the latter. I think very few people enunciate the latter, but it was important to us. Things like avoiding conflicts of interest vis-a-vis the clients and acquitting them in favor of the clients when the conflicts can't be avoided. Having a apolitical, non-hierarchical environment, very important to us. Candid communications, not taking credit for successes that are not our doing, not hiding behind excuses for failures. These kinds of things were very important to us, and so we wrote them out. Now and by the way, at the end we concluded by saying, if we do these things, we'll have a successful organization, and if we don't do them, we won't deserve to have a successful organization. And I feel that very strongly, and the success came from following these principles and our investment philosophy. We've added two in the 30 years. One explains the conditions under which we will add a new strategy, and the second talks about responsibility. And the founders of Oaktree are united in believing that we have responsibilities that go beyond making money, and responsibilities to the planet and to our and to the people we inhabit the planet with, and those things are important to us as well.
I mean, the rest is history. The firm is obviously, historic. It's a legendary story. I suppose double tapping on that, was there ever a time where you perhaps came close to veering away from those principles or investing philosophy? Or
well, I mean, I don't think there's any one time that's worth talking about, but I'll just say that if you have principles like those, especially on the business side, doing those things sometimes appear likely to cost you money in the short run. And the question is, will you sacrifice some short-term profit in the interest of following your values? And I think we always answered yes. And the key, Emanuele, is I believe when you talk about doing the right thing, it's easy to know what the right thing is. Sometimes it's hard to do it because there is a cost associated. But we have, since we share values rather than disagree, I think we have supported each other in doing the things that are right according to the principles, and not always the immediately most profitable. And it's a pleasure to do that. We've been very successful. We've made lots of money for ourselves and for our clients, and making more money at the expense of some of those principles, it would not have been worth it to me.
So taking the long-term view and a long-term view on
well, at Goldman Sachs, they have a concept, or they had, I don't know if they talk about it anymore, but when we were starting up, it appealed to us, a concept called long-term greedy. And greed is, of course, a controversial word because it has some negative connotations. But basically, what they're saying is, we want to do the things that will maximize our economic values in the long run, sometimes at the cost of not maximizing our financial success in the short run. And every organization has to decide at some point, do you want to maximize the short run or the long run? And are they different? And, I think that I think we have always believed that doing the right thing will lead to the greatest success in the long run. And we have opted to do so, sometimes at the expense of the short run.
So I'd love to know, where does this kind of business DNA and investing DNA come from? Because nowadays it's readily and easily accessible to read, Munger's work, Buffett's work, your work, of course. Back still honing in on the early days, I'd love to know where that came from.
Oh, I think it comes from one's parents, and some people might argue that we have some genetic predisposition to certain forms of behavior, but then whatever our genetics are, our early influences are parents, clergy, and teachers primarily, also role models and peers to some extent. And so, I think that we're the product of our upbringing, and my upbringing, my parents and as I say, clergy and teachers and role models, people like Charlie Munger and Warren Buffett, had a very strong impact on us. And I wrote a memo around 2002 called "The Most Important Thing," which, as you know, became 2011 the title of my book. And the memo, like the book, had a number of sections, and each one said the most important thing is, and then it was a different thing, because in our world there's no one thing that matters. There are many, many things that have to be included. It's kind of like bricks in a wall. And in the memo, not in the book, because the book's about investing, and this is not an investing topic, but in the memo, I talked about the importance of a successful partnership. And I said, I thought that the keys to a successful partnership are shared values and complementary skills. I can't imagine having a happy partnership with somebody who differed with me on values. I'm conservative, somebody aggressive. I'm ethical, somebody who cuts corners. I'm patient, somebody who's, just can't stand to wait. And so we knew when we started that the five of us shared the values, and we never had a values-based disagreement. But we also complemented each other. The greatest example is Bruce and me. We've been partners now for 38 years, happily. We've never had an argument, but we're very different. I think fast, he thinks slow. I come to gut conclusions, instinctual, if you will. He tends to chew things over and reach a conclusion only gradually, and then come back the next day and say, you know what, I thought it over, and I think I was wrong. I think this is the way to do it. And it's very valuable that we do both. I like to be out on the road talking to our various constituencies, like with you now. He likes to stay back and manage the money. So very good complement, and that's key. If one partner ends up saying, hold on, what's going on here? I can do everything I can do, and I can do everything he can do. What do I need him for? That's when partnerships become unhappy and fall apart. And so I think complementary skills, rather than redundant skills, are very important.
I suppose then shifting our focus to your incredible, and as I said, legendary investing track record, I'd love to know, I suppose no career line is straight. Would you be willing to talk about maybe a challenging moment in your career, or perhaps, I don't know if it would be correlated, but, an unsuccessful investment?
Well, I'm not close enough to the individual investments to want to talk about an unsuccessful investment. We've had some, of course, but I think a great example of a tough time is the period from the beginning of 2009 to the end of 21. I wrote a memo in December of 22 called Sea Change. And I talked about that period at length. And it was a period in which, because of the global financial crisis and the pandemic, the Fed funds rate was zero most of the time over those 13 years and averaged about 0.5%. Well, if your job is to lend money and the base interest rate is zero, then the returns you can earn just can't be that substantial. Even if you do a great job, kind of it is what it is. And I'm a great believer in it is what it is. We're presented with an environment. We can't change the environment or ask for another one. We can't abstain from activity. So, my recurring speech title in that period was investing in a low return world. And if returns are low, unsatisfactory, and high yield bonds 3.5 years ago yielded 4, I considered that unsatisfactory, and it wasn't very helpful for my clients. If prospective returns are low, how do you increase them? You can work harder, you can have more skill, but hopefully you've been working as hard as you can already and applying all the skill you have. So the real main thing you can do usually is take more risk. Go further out the risk curve in the pursuit of higher returns. And, we probably thought about that possibility, but never embraced it because it's just not who we are. And it's not what the clients came to us for. And remember, I went through our investment philosophy. Tenet number 1 is risk control. And I think that's what we're known for. That's what we've delivered for almost 40 years of working together. And if you desert your principles and you don't do what you told people you would do, then I think you have nothing left. So we just had to, I described that period as being in the wilderness. We couldn't raise money in those areas. And we just had to wait until that period was over. And most of our strategies had the lowest returns in their history on a prolonged basis because we were in a low return world.
I suppose on the flip side, what was the most kind of exciting part of your career or a career highlight?
Well, I mean, an example would be the years leading up to and the beginning of the global financial crisis. So in 05-06 into 05-06, I was very worried about the markets. And I was taught at University of Chicago that the thing that keeps markets working and keeps them safe and sane is risk aversion. People are inherently risk averse, and they have to be motivated to take incremental risk with the prospect of incremental return. That's why the risk return curve slopes up to the right. And so if they are risk averse and demand risk compensation, then they will not take risk stupidly. But in 05-06, I had the impression that they were doing so. And in pursuit of high returns, people were doing deals that shouldn't have been done and not demanding sufficient risk compensation for the risk they were taking. And, Buffett has a great quote. He says, the less prudence with which others conduct their affairs, the greater the prudence with which we must conduct our own affairs. What that means is when other people are carefree, we should be worried. When other people are terrified, we can turn aggressive. And I believe that's one of the very strongest things I believe. And people were unworried. And, I describe myself as wearing out the carpet between my office and Bruce's on a daily basis, saying, look at this piece of junk that got issued yesterday. A deal like this should not be able to get done. And if this deal can get done, that tells me that the market participants are not fulfilling their responsibility as as guardians or as vigilantes or disciplinarians. That's probably the best word, disciplinarian. And so we agreed that this was worrisome, and we sold off the majority of our real estate holdings. We liquidated large funds. We started small funds or none at all. And we raised our standards for investing. And it's hard to apply high standards when the people you're competing against in the marketplace are applying low standards. You don't get much business done usually, but that was okay. And at the beginning of 07, we said we think there's a special opportunity coming. We went to date, the largest distressed debt fund had been our fund 4 in 2001. So we said, we think there's a big opportunity coming. We'd like to have $3 billion. And by the end of that month, we had 8. And true to our values, we said we can't do anything with $8 billion. So we're going to close on $3.5 billion, and we did so. And we said, but we'd like to have the rest of your interest for a standby fund. So we closed on $3.5 billion for Fund 7. We said we'd like to have a standby Fund 7B that we'll only activate if there's a deluge or after 7 is invested. And by the end of marketing for that, we had a year to market it. So the first close was March 07. The last close was March 08. And by the time we were done, we had $11 billion. And remember, this is an area where the biggest fund in history was 2. We put it on the shelf. We said to people, we're not going to spend the money until there's an opportunity. And we're not going to start charging fees until we spend the money. So we put it on the shelf. 1.6% of $11 billion is 160 million a year that we didn't take. We waited a year before activating that fund. We did so in June of 08. We started investing it slowly because Fund 7 was finished doing its business. But then we had $10 billion unspent the day Lehman went under and the markets collapsed. And then the question was, well, should we invest now, or should we keep our powder dry in reserve? And there was no way. People were talking about you probably don't remember, but this was 17 years ago. People were talking about the end of the financial system. We had lost Merrill Lynch, Bear Stearns, AIG, Lehman Brothers, Wachovia National Bank, and Washington Mutual, and everybody said, well, it's all going to melt down. And so why would you invest if it's all going to melt down? Well, we concluded very simply that if we spent the money and the world melted down, it wouldn't matter. But if we didn't spend the money and the world didn't melt down, then we hadn't done our job. So we felt we had to spend the money. And Bruce Karsh is very, very strong in his discipline. And he invested an average of about $450 million a week for the next 15 weeks. That's $7 billion in one quarter. And, that's all you had to do. And so that was a very proud moment for us, maybe the most proud. And by the way, you can see the result you mentioned the memos earlier. I think the great thing about the memos is I can tell you what I was thinking back then, but you can read the memos and you can read what I was thinking in real time. And I'm very proud of them, in particular of a memo called, there was one called Nobody Knows. Lehman went under, I think, September 14th. They announced bankruptcy, and I put out Nobody Knows, I think, on the 19th. So it goes through this reasoning. And then, on around October 10th, which might have been the low ebb, I put out a memo called The Limits to Negativism, in which I said, one of the main jobs of the investor is to be a skeptic and to be mindful of excessive optimism. And at some point in time, if somebody says, well, I've made 12% a year for the last 30 years, I've never had a down month. Your job is to say, no, Mr. Madoff, that's too good to be true. But that's not the whole job, because it's also your job to be mindful of excessive pessimism. And markets reach a time in a crash when you could say, no, that's too bad to be true. And I'm very proud that we did so. And you can read about it in that memo, and I hope people will. By the way, the memos are available at oaktreecapital.com, and they're free, and they're there. 35 years of memos are there, as you know. And if you subscribe to the memos, we don't use it as a marketing mailing list. So you can subscribe to the memos without getting any other mail from us if you don't want to.
At Trinity, they're very popular. Also, you have the podcast version as well, which a lot of people listen to. I mean, it's incredible to hear about that story in 2008 and how you had the foresight, 04, 05, 06, leading into the crisis. And I suppose just touching on that, so you have the memos, which does reveal kind of the internal dialogue. But I'd love to know, being a contrarian investor, what is that like, especially in those early years? Say if we go back to 2008. Having the foresight for the reserve fund. Yeah. I mean, it's incredible, but yeah.
Well, first of all, I think you have to have a sense of what's going on around you. I mentioned that one of our investment principles is that we don't make our decisions based on macro forecasts. Right. And I always say we never know where we're going, but I also say we ought to know where we are. And if you can tell what's going on around you, and especially in terms of other investors' behavior, you can get a sense for what you should do. And as you say, a lot of what you should do falls under the heading of being a contrarian. You shouldn't do the opposite of what other people are doing just for its own sake, but you should look at other people's behavior and say, what are they doing? Why are they doing it? What's wrong with that? What do I think? What's the difference? Might I be right? Might they be right? If they're right, what happens? If I'm right, what happens? What are the probabilities? It's not an easy decision, but I think you have to be at the extremes. When the market's extremely high because everybody loves it, or extremely low because everybody hates it, clearly you have to do the opposite. And that's what contrarian behavior consists of. And at the extremes, it's usually right. However, you have to have a thick skin, because if you do the opposite of what everybody else is doing, you're not going to be successful the next day. The trends that have been in motion are going to continue in motion for a good while, and you're going to look out of step. You're going to look wrong. The first of the great adages, I use all the great adages in the memos. The first one I ever learned in the early 70s was that being too far ahead of your time is indistinguishable from being wrong. So you have to reach a correct conclusion. You have to be aware that even though you think it's right, it may not work for a while. And you have to be aware that in the interim, you'll look wrong. But you have to do it anyway. And so Dave Swenson, who ran the endowment at Yale, who was by far the thought leader of the endowment world and many other aspects of investing, wrote a book called Pioneering Portfolio Management, in which he said, investment management requires the adoption of uncomfortably idiosyncratic positions. And I think that one statement contains a vast amount of knowledge, wisdom. If you're going to be a superior investor, in some ways, your behavior has to be idiosyncratic. If you behave the same as everybody else, that's not a very good formula for being superior. But if your behavior is idiosyncratic, and as I described, unlikely to be successful right away, you're going to be uncomfortable for a while. If you're doing the opposite of what the crowd is doing, and you're not a little bit uncomfortable, there's probably something wrong with you. But you have to do it anyway.
Now, you are highly knowledgeable on history and also, I should say, economic history. I'd love to know, is there an event, Bubble Watch, you referenced the South Sea Bubble, Tulip Mania. Is there an event in history you think, students or generally people investing should study in order to gain lessons from?
Well, you should study them all. There's no one. The benefit really comes from repetition. Mark Twain, the great American humorist and writer, said, it's said that he said, history does not repeat, but it does rhyme. So the details of every historic episode are different, but there are certain themes that rhyme from episode to episode. And if you read about a number of them, you can distill them and you can apply them. So, for example, when people are not sufficiently concerned with risk, they take too much of it and don't allow for the downside. When in large part they do so by levering up their portfolios, by borrowing money so they can invest more in the hope of magnifying their successes. But if they do that in the wrong time and the wrong way, it magnifies their failures and they can get wiped out. And the fact that when things are really going hot and everybody's making a lot of money, people forget to be risk averse, and the only fear they embody is the fear of missing out. And believe me, losing money is much worse than missing out on gains. But they forget that. So these are the general patterns, rhymes that repeat in most cycles, in bubbles and in bull markets. And so you just have to read about them and understand these tendencies. So, and a lot, we know nothing about the future. We'll never know anything about the future. The only thing we know is we know the past, and we believe normally we can extrapolate a lot of the past into the future. We don't know exactly which aspects or to what extent, but generally we can, and that's how we operate. We do not study the future. It is, I keep insisting that it is an oxymoron to say we study the future. There's nothing there to study. So we should study the past and understand its implications and understanding its tendency to repeat. And that's what I urge people to do. So you can read a couple books. If you want to learn about this subject,
Mastering the Market Cycles.
Well, that's my own, and that's up to you to push. I'm not going to push my own book, although I hope people will buy several copies. But I think I can name two books in particular. One, the greatest, is called Devil Take the Hindmost. And it is the history of financial speculation as told by one of your paisans, one of your countrymen, Edward Chancellor. And I read that book in the fall of '99, and he talked about, he reviewed the patterns. And he talked about the South Sea bubble, and he talked about the people that were leaving their day jobs to day trade the stock of the South Sea Company, and things like that. And I said, holy cow, that's exactly what's going on today in what turned out to be the tech bubble of '99. And so I started writing the memos in 1990, as you know, but on the first day of 2000, I published one called bubble.com, which was the first one that got any attention at all, because it was right, and I didn't have to wait long for it to be right. So it didn't look wrong for long. And but it talked about mostly the similarity of '99 behavior to other bubble behavior, South Sea bubble behavior. The other book I would mention is one called, it's less scientific, shall we say, but it's called A Short History of Financial Euphoria by John Kenneth Galbraith. And I like it because it was truly short. I'm a very slow reader, So it helped. I think it's only about 100 pages. And I must say it concludes by taking a slap at high yield bonds, which is how I made my living. So I didn't like that part. And I don't think it turned out to be warranted. But again, talking about the ups and downs of psychology, which is extremely important if you're concerned about the short run. And by the way, we all have to live through the short run. And some very trenchant observations. For example, he says one of the main characteristics of the financial markets is the shortness of memory. And this really is very relevant to what we're discussing here, Emanuele, because what it says is that, the philosopher Santayana said, those who are ignorant of the past are bound to repeat it. And when people forget the past, as they do, as Galbraith said, they repeat it. And so these themes that you see in every bubble are repeated with the same result, which is that things go crazy on the upside. Everybody jumps in because they can't stand the FOMO. And, there's a book called Manias, Panics, and Crashes, or I think that's the title, by Kindleberger. And in the later editions, there's a great statement. It says that there is nothing so injurious to your mental well-being as to watch your friend get rich. Now, that is something that is absolutely true. It's part of human nature. It is not true of the South Sea bubble, but not the rest. It's not true of the tech bubble, but not the rest. It's always true that it's, envy and comparing yourself against others is one of the strongest forces in human nature. And it will always be so, in my opinion. And as a consequence, it'll always be a contributor to and a hallmark of bubbles, and you should watch for it.
And absolutely. So, Howard, I'm just looking at the time. I want to be respectful of your time. So thank you so much for coming back. If you ever find yourself in Dublin, it would be a real honor to give you a tour of our campus. You're welcome anytime. So thank you very much again for the time and coming back.
I'd like to come back to Dublin. Thank you, Emanuele. Thank you.
Thank you very much.
Thank you for having me on today.
You have been listening to the Trinity SMF podcast. You can find more of this podcast on our website, www.trinitysmf.com, and follow us on our social media to find out more about the podcast releases, upcoming events, and much more. Thank you again for listening, and stay tuned.